The American banking system is facing a crisis of confidence. After years of relative stability, 2024 has brought a series of shocks that have exposed vulnerabilities in the financial system. The collapse of several regional banks, coupled with high-profile bailouts, has left many Americans wondering if their money is safe. The situation is reminiscent of the 2008 financial crisis, with whispers of systemic risk and contagion spreading through the markets. While the current situation is not yet as dire as 2008, the parallels are unsettling. The root causes of both crises are eerily similar: lax lending standards, opaque financial instruments, and a regulatory environment that failed to keep pace with innovation. The rapid rise in interest rates, coupled with persistent inflation, has put immense pressure on banks' balance sheets. This has led to a decline in lending, a slowdown in economic growth, and a loss of faith in the financial system. The stakes are high. The banking industry is the lifeblood of the economy, providing the credit that businesses need to invest and grow. A prolonged banking crisis could have devastating consequences for Main Street America, leading to job losses, business failures, and a decline in living standards. It is imperative that policymakers act swiftly and decisively to restore confidence in the banking system and prevent a full-blown financial meltdown. The collapse of Republic First Bank in April 2024 sent shockwaves through the financial system. Once a pillar of the Philadelphia banking community, Republic First Bank was failed by a toxic combination of bad loans, poor management, and a rapidly changing economic environment. The bank's failure was a stark reminder that even seemingly healthy institutions can be brought down by a confluence of adverse factors. Republic First Bank's troubles began long before 2024. The bank had a history of aggressive lending practices, particularly in the commercial real estate sector. As interest rates rose and the economy slowed, many of these loans soured, leaving the bank with billions of dollars in bad debt. The bank's management, slow to recognize the severity of the problem, failed to take timely action to shore up its balance sheet. The Federal Deposit Insurance Corporation, FDIC, was forced to step in and seize the bank, selling off its assets to a larger institution. While depositors were protected by the FDIC insurance, the bank's shareholders and bondholders were wiped out. The collapse of Republic First Bank served as a wake-up call for regulators and investors alike, highlighting the fragility of the banking system and the need for greater oversight. The current banking crisis is the result of a perfect storm of economic and regulatory factors. The Federal Reserve's aggressive interest rate hikes, while necessary to combat inflation, have put immense pressure on banks' balance sheets. As interest rates rise, the value of banks' bond holdings declines, eroding their capital cushions. At the same time, higher borrowing costs have dampened loan demand, slowing down economic growth. Inflation, which has remained stubbornly high, is another major concern for banks. As prices rise, so too does the cost of goods and services, eroding consumers' purchasing power. This can lead to a decline in consumer spending, which in turn can hurt businesses that rely on consumer demand. Banks are particularly vulnerable to inflation because they lend money in today's dollars but are repaid in tomorrow's dollars, which are worth less. Regulatory changes implemented in the wake of the 2008 financial crisis, while well-intentioned, may have also contributed to the current crisis. The Dodd-Frank Wall Street Reform and Consumer Protection Act, for example, imposed stricter capital requirements on banks, which made it more difficult for them to lend money. While these regulations were designed to make the banking system safer, they may have also made it more difficult for banks to adapt to changing economic conditions. Section 4. Ripple effects. The impact on communities and the economy. The banking crisis is already having a significant impact on local communities and the overall economy. As banks tighten lending standards, businesses are finding it more difficult to secure the credit they need to invest and grow. This is particularly true for small businesses, which are the backbone of the American economy. A decline in small business lending can lead to job losses, business failures, and a slowdown in economic growth. Consumers are also feeling the pinch. As banks become more risk-averse, they are less likely to approve loans for mortgages, auto loans, and credit cards. This can make it more difficult for consumers to buy homes, cars, and other goods and services, which can further dampen economic growth. The decline in lending can also lead to a decline in home values, which can erode household wealth. The banking crisis is also having a ripple effect on the stock market. As investors become more concerned about the stability of the financial system, they are selling off bank stocks, which has led to a decline in the broader market. A prolonged decline in the stock market can erode investor confidence, which can further dampen economic growth. Section 5. Looking ahead, navigating the uncertain future of banking. The future of the banking industry remains uncertain. The Federal Reserve's efforts to combat inflation, while necessary, are likely to continue to put pressure on banks' balance sheets. The economic outlook is also uncertain, with many economists predicting a recession in the near future. A recession would likely lead to an increase in loan defaults, which would further strain the banking system. Despite these challenges, the American banking system is more resilient than it was in 2008. Banks have significantly increased their capital buffers since the financial crisis, and regulators are more vigilant in their oversight of the industry. However, the current crisis is a reminder that the banking system is not immune to shocks, and that more needs to be done to ensure its long-term stability. Policymakers must strike a delicate balance between regulating the banking industry to prevent future crises and allowing banks the flexibility they need to innovate and support economic growth. Banks, for their part, must adapt to the new economic reality by strengthening their balance sheets, reducing their exposure to risk, and innovating to meet the evolving needs of their customers. The road ahead will be challenging, but by working together, policymakers, regulators, and the banking industry can navigate the uncertain future and ensure that the American banking system remains the envy of the world.